Hello, nice to see everyone. I know there's some folks online as well, and I know we don't have a lot of time, so we'll get started. Feel free to ask questions as I go through. You don't have to wait to the end if you have them. Okay, so to begin with, when you have an idea that you want to commercialize, there needs to be some research into the market. So you need to understand if the market has a need for your product or service. And in order to determine that, you have to look for objective and verifiable data and do some direct discussion with the potential customers or clients that you might engage with. So you need to demonstrate that there is a need for your business, service, or product, and that the need is great enough for the business to be viable. So we might think about things like you've heard things like total addressable market. How many people have the problem you're trying to solve? Where are they? Could you reasonably reach them? Is the problem so great that they will want to change what they're doing to purchase that product or service? And also, who's also doing it? So are you going to be someone starting a product or service in a white space in the market, nobody's doing it already, or you're doing something better than someone's already doing? Those are all really important things to know before you get rolling. Okay, so it's a great idea to have fellow travelers on your entrepreneurial journey. So no matter how brilliant everyone is, no matter how energetic, it's still a heavy lift to start a new company. And there's no one on the earth that has all the skill sets needed to do it well. So it's a really good idea to have other folks to collaborate with that have skill sets that are different than your own. I always tell the story that I was asked to judge a pitch competition that was for all of Western Pennsylvania through the ARM a few years ago. And I had to look at 12 startups in one afternoon. And of course, they all had their team slide. And out of the 12 companies, not one of them had an advisor in finance, which was astonishing to me. It's just really hard to think about. Everybody had a CTO. Everybody had tech. None of the 12 had somebody that could help them with a finance strategy. So obviously, to start up a company, you have to have money. In order to get that money, you have to have a finance strategy. And I've seen lots of companies that have a wonderful idea and they get a really strong start, and then they don't have a strategy to continue their momentum by having the appropriate amount of capital to do that. Really important when you're starting. It's not just the tech, it's not just the product market fit. It's a finance strategy from the earliest stages. So obviously, when you're starting, you have an idea, you don't have a lot of capital, you don't want to hire someone maybe, but a co-founder or two or three is a great way to have those complementary skill sets and compensation through equity. So as the company succeeds, everybody wins. Okay, an actual business plan. A business plan is one of the many documents that you'll be asked for by prospective funders. Funders for debt, funders for equity, anybody that is going to invest in your business either way needs to read your business plan. And what's great about it is it's an actual document with an actual format. You can get the structure of it. There's a million of them online. I'm sure we have one somewhere here in the Swartz Center website, a format for it. It's a great exercise, super, because it takes you through all the elements of a well-structured business and helps you to have an outline format where you can address all of them. Makes you think about everything that needs to be thought about to get a solid business going. So it talks about, what your business is, how you will make money, all of the ways that you'll do that. You'll have to have a marketing section and a finance section and a sales section. You have to talk about the corporate formation, all the elements of a business in a pretty tight format that will be a document that you can then share with other people and say, does this hang well together? Does this seem to make sense? Is this something, do you think I'm missing something big? So highly recommend that. That's a great way to begin and share it with other people and be open to their feedback on it. And then update it. It's not one and done. When something significant changes, update the business plan. If you have a current business plan throughout your journey, you will astonish many people. I can't tell you how many times I've asked someone who comes to me and says, will you help me raise money? Do you have a business plan? If you have one, it makes you head and shoulders above lots of other folks. Okay, my favorite part as a CFO, the financial model. So the business plan is a place where you put together your ideas sort of with words. Not that you don't have to have a finance section, of course you do. But the financial model and the pro formas tell your story in numbers. And it's very important because it gives you a place to share what you think you're going to be able to do with your startup financially. And again, share it with people outside to get it vetted. Does this make sense? So if you look at the Connect videos that are coming up later this week, one of them talks about, how to pitch to investors. If investors look at your pro forma and you haven't begun your business yet, in 2024, you say you're going to have $1 million in sales. Well, maybe not. That's going to be, there's going to be some folks that are going to maybe say, I want to know a little more about how you're going to do that. If you've got 200,000 in sales this year and you say you're going to have 4 million next year, you're going to have a lot of folks saying, really? How? Through what sleight of hand? So when you consider your plan for your business, and you set it into a format, you begin with the income statement. You project your sales revenue. That's going to demonstrate your go-to-market strategy and your pricing policy, right? So how many customers are you going to get in that first year? What are you going to charge them? When are they going to pay you? What are your terms going to be? What are the costs you're going to incur to support the generation of that revenue? Very good idea not to include big salaries for yourself in the first year. That's another red flag that I've seen. So even if you raise a bunch of capital, you don't use it to pay yourself, especially in the first year. Okay, gross and net margin. So gross profit is a dollar amount. Gross margin is a percentage. Net margin, net profit is a number, a dollar amount. Net margin is a percentage. So gross margin, gross profit is the difference between your top line revenue and the direct costs it takes to produce your product or service. So your cost of goods sold. Net income, gross margin is the sales revenue in the denominator, gross profit in the numerator. It's a percentage. It's just a little bit of math. But the reason it's really helpful to know is because different industries have expected gross margins. And since it's going to be a while before you're profitable, hopefully not too long, but it could be, people look at the investors and, again, debt or equity, they look at that gross margin line to see the trend. So you want your gross margin to be, obviously it should be positive all the time because you're selling something and you're able to produce that thing for less than you sell it for. If you can't, you shouldn't, it's crazy, right? You shouldn't be doing it. But different business models are going to have different gross margins. So for example, if you are a tech company and you are a SaaS model, software as a service, your gross margins at the beginning could be in the 50, 60, 70% range, but ultimately they're going to be well above 95. So if you're putting forward a pro forma that says you have a SaaS model and you don't get those kind of gross margins within a reasonable period of time, you need to go back and say, gee, what's happening here? On the other hand, let's say I have a new client right now that's a manufacturer. In manufacturing, you have a lot of upfront costs for property, plant, and equipment to build a factory to make what you're making. And you could have robots, things that are quite expensive at the beginning, but their useful life is more than 10 years, but you have to have the capital to put them forward at the beginning. So your gross margin initially is going to be in manufacturing could be more like 50%, 55, 60 could be very good in manufacturing. So there's information available in the public domain about a reasonable gross margin for your business model. That's a good way to test the financial model you're putting forward. Growth rates. Yes.
There are different levels of fidelity of the financial model as you go throughout the process, or like is the first model you make as detailed as whatever you have like a year later?
That's a good question. It's you're going to build the model using whatever knowledge you have. So you're going to start with whatever your product or service is. You're going to think about your pricing structure. So are you a market maker or a market taker? If you're the first to market with something, it doesn't exist anywhere, you're still potentially meeting a need that's already being met some other way, or you're going into a market that exists. You can see what competitors are charging. You can say, well, I'm twice as good, so I can charge twice as much, whatever. You're going to think about your pricing. If you're a market taker, the market's going to say you can get this much for what you're doing, and maybe a little bit more, but this much. So you have to be able to produce your product so that you still make money at that price. So you're going to project your sales revenue, of course. You're going to know what it costs to the best of your ability to produce that. Then under your expenses, you're going to have a lot of latitude. So do you spend any money on marketing? What kind of marketing? Do you hire someone to do sales, or do you do it yourself? Do you hire someone outside to keep your books, or do you do that yourself? There's a lot of expenses that you have latitude to take on or not. As your business grows, some of those things that you were doing yourself at the beginning, or you and your co-founders are doing, will have to be done by someone else because your company gets too big for you to continue to handle them. So I would recommend, well, it's been my experience that you look at a standard chart of accounts. Does anybody know what a chart of accounts is when I say that? Okay. So I have a video on CMU Connects, and it talks about how, as a startup, you set up your initial books. And it goes into the details of the 3 languages of business: accounting, finance, and economics, and talks about how they intersect. Every business has a financial structure. That financial structure begins with a chart of accounts. And what it is if you think about a business, money comes in and money leaves. So it comes in from sales revenue, from investment, right? From loans. That's how it comes in. It goes out on everything you spend. And you have to keep track of money in and money out. And the way that's done is with buckets. Okay, sales revenue is a bucket. Property, plant, and equipment is a bucket. Marketing expense is a bucket. Everything has its own account. And those accounts are structured into a document called a chart of accounts. And it's just a list of all the accounts that you're using. If you look at, if you go to, you subscribe to the free, there's a $15 a month version of QuickBooks Online. If you were to subscribe to that, you go to an icon that says list, and you pull down a chart of accounts, and it says, here's one that you can start with. And it has maybe 50 accounts, but it has an option for up to 250. So that's a whole nother conversation, but it's a good idea to look at one. look at all the options for the accounts that you have and try to use the income statement accounts for your initial pro forma. So structure it that way. Look at all the accounts that are at a base level. You need all of these things and try to project all of them and then do the math and say, okay, given what I think, am I making money or am I not? So when we talk about I'm skipping to burn rates. When we talk about burn rates, a burn rate is the amount of cash your company burns on a monthly basis. So if you win a contest or a pitch contest, you get $25,000 and you spend $5,000 a month for 5 months, 5,000 is your burn rate. Okay, so typically when you begin a company, an early stage company, you're going to have more money going out than coming in. So you're going to have a net loss at the end of every month, and that net loss is your burn rate. As you put your product into the market, you start to have sales, people start to buy your product or service, your burn rate goes down until it gets to zero, which is when you hit break even, and then you start to be profitable. It's very important to understand the timing of those things, because one of the things that your pro forma tells you is how much capital do I need to reach profitability? And when you start raising money, what I've seen a lot of businesses struggle with is they're so excited that someone wants to invest $100,000 in their business. So they take it and they start doing what they do, and then they run out of capital. And then they think, oh, I need another 100. No. A finance strategy says, I do a pro forma, I understand how much capital I need to get to profitability, plus a margin for working capital, which is a whole nother thing. And that's how much I need to have a finance strategy that says, this is where I'm getting all that money. If I only have 25,000, I'm not saying don't start. I'm saying pretty early on, figure out how am I going to get how much do I need to get to profitability, and where's it going to come from? Very important, not to just get started and hope for the best. Okay. Growth rates, very important. Again, we were talking in the early stages when you look at your projected sales revenue, and economic indications are that the market that you're in is only going to grow by 3% a year for the next 5 years, and you're projecting 10 or 15% growth per year, you're going to have to be able to defend that in your business plan. Why are you going to grow faster than the market for that particular product or service? And you could have a very good reason for that. You could be building something that's just excellent, solving a huge problem. And so you are going to grow faster, and you may only need a small percentage of the market to grow, or you could just be at the right place at the right time. But you have to be mindful that you can't just put a growth rate out there without grounding it in some evidence. Okay, so we talked about that. Yes, experienced investors are going to expect detail on every line item. So you don't just throw numbers out there. And I've seen it so many times. I need to estimate marketing spend. I'll just put $500 a month in there. But it doesn't work that way. You don't just plug a number. You actually find out what it costs to buy what you need. Yes.
So let's say we do an estimate of the costs that are associated, on a month basis, because we're trying to understand our burn rate. Do you ever recommend having a percentage of contingency, especially if we might suspect that there's some, costs that we thought were fixed but ended up being variable costs?
That's a great question. Of course. So what's important is that there's never one pro forma. There's 3. One is called most likely. That's the one you start with. That's the one where you put in, this is what I think is really going to happen with that within a reasonable estimate. Best case, if everything goes right and super things happen that I wasn't expecting, every domino falls the way I want it to. That's what could happen. Worst case is if everything goes wrong, or most things go wrong. The sales that we think are going to happen later. They're going to be lower than we think. The costs are going to be higher, that kind of thing. You look at 3 scenarios, not one, so that you understand the potential timing and capital need. That's the way you look at your contingencies. It's not you just add a percentage at the bottom. You don't do that. Anybody else? Okay, very good. All right. Potential customers, you want to actually talk to them, as a lot of them. So if you have a new startup and you're going to have a product that's a consumer good, and it's going to be used by a certain demographic, talk to 100 of those people. Ask them, this is what I have. This is what I'm thinking about. Would you buy it? If you did, how much would you pay for it? At Carnegie Mellon, there's a program called Project Olympus that focuses on product market fit. They're excellent at this. Excellent advising, excellent process. It's a great way to start. It's just for CMU community, and Kit Needham runs the program. It's wonderful, and you can find it on the Swartz Center website. So when you have your minimum viable product, or even a test version of it, or if it's a device, again, the first one, and you take it to your potential customers and have them use it, try it, consider it. Write down what they tell you. Write down what you're hearing. What is it that makes them want to engage with it? What is it that they think should change? It's a really good idea to structure your data inquiry, right? So if you're going to meet with 5 customers, potential customers, or 10 or 20 or 100 or 200, ask the same series of questions in the same order, said the same way, so that the data you're collecting can be analyzed in a reasonable way. Don't just have a loosey-goosey conversation. Have a structured way of asking questions so the data that comes in can be compared. Okay. If someone loves your product, just loves it, it solves a problem they've been dying to solve, you have a solution that they are marveling at, get them to give you a testimonial. It's very important. It can be included in your pitch. The more, the better. Okay. So it's a really good idea when you start a business to have it be in an area in which you as a founder have some real ability. Or the role you're taking on in the business has some link to your real ability. So for example, the first company that I started, I had very little experience in the product, but my co-founder, who was COO, had decades of experience with the product, knew how to buy the raw materials, knew how to deliver the product, knew the whole process. But what I brought to the table was I knew accounting and finance and legal and sales and contract law. I set up the business. I did the corporate formation. I understood what corporate formation was right. I understood how to establish the books, how to do all that. So the COO could run off and do everything that needed to be done to deliver the product to the market, and we cash flowed our first month. So so again, use something you've already done. You don't want to start a business in an area that you just have no, and actually I've seen it done. If you see a need that needs to be met in the market and isn't being met, and you have a solution, I know this would work. Find other people that then have experience doing that thing to co-found with you. And again, training and outside resources are available in abundance here to help you. This is about the best place and best time I can think of to start a company. There's just so many resources here. And at CMU, of course, and in the Swartz Center, of course, but there's also lots of other places in Pittsburgh as well. There's just we have abundant resources. And if you need something, please don't hesitate. Just ask or reach out. Ask. There's lots of people to ask. Feel free to reach out to me as well. Okay. When you establish your business, it's very important to establish a brand. It's important to have some of the things that may seem not terribly important when you're founding. They are important. you need to be able to, when you're putting a new product or service into the market, it needs to be identifiable. People need to understand what it is, what it does, and why it's different pretty quickly. So there is a wonderful book that I read here when I was a student. It was written in the 50s, and it's still the number one text on market positioning. It's called Positioning. And it's this tiny little book, and it's super important when you're establishing a brand. It tells you how human beings think and how to establish your brand in a way that you're doing it in a space that isn't already taken by someone else. That's kind of a key thing in marketing. So I've seen a lot of early stage companies not spend a lot of time on the marketing piece, not spend a lot of thought. I've done it myself, actually. It's very important when you're starting a company to engage with someone who thinks about and understands marketing. And also, marketing and sales are not the same thing by a long shot. They're hugely different. If that's a surprise, please learn about the differences. So again, marketing, we're talking about establishing the brand, creating market awareness for what you're doing. Selling is completely different. Selling is process-driven. It's repeatable, or should be. It's data-driven. It's something that is done every single day in the same way, so that you can determine what, how long your sales cycle is, what it takes to close a new customer, how much it costs, who's best at doing it. Sales and marketing are distinctly different. You need them both. Okay. Okay, let me make sure okay, brand. Okay. So whenever you're starting a company, you're going to need money. So how much money do you need? When do you need it? What will you use it for? Those are really important questions to ask. And the best way to answer them is to go to your pro forma. So again, the business plan is your starting point. You write down your ideas in every section of the plan. You say, this is what you sort of describe in writing what you would tell a person. If I was to sit down with you and say, you can have a free hour of consulting, tell me about your business, you'd start telling me what it is, who it serves, how you describe it. All of that is what you write down in the business plan. Then you describe your business in numbers in the pro forma. And then you take the pro forma to answer these questions. So how much money do you need? When you develop your pro forma, you look at your burn rate from the time you start until you reach profitability. You add up how much your burn is, and that's how much you need to get to profitability based on your current projections. And then in addition to that capital to get to profitability, you have to have enough cash to cover your cash cycle. Your cash cycle is the amount of money you need. So let me give you an example. It's from the time that you make a product until you sell it, and the money you're getting for selling it arrives in your bank account. So just because you made a sale doesn't mean you have the cash. You sold something, and unless your payment terms are immediate, which most are not in business, especially if you're selling you have a B2B model, there could be a delay in you getting the cash for 30, 60, sometimes 90 or more days. I have seen businesses that are very fine, that have a great market reputation. They have great customers. People love what they do. They've been doing it for decades. Struggle and come close to failing because their cash cycle was not funded. They didn't have the money to pay their bills because it took too long to collect the money from the people that owed them. So when I say your pro forma says if I sell at this cadence, if I have costs at this level, I will become profitable in this many months. The total of your burn is the amount of capital you need to get to profitability. But in addition to that, you need to have enough cash to cover your cash cycle. Yes.
So, yeah, and I understand that you want to know exactly when is the business is gonna, go from break even to start making profits. Would you, and I feel like you already answered this question, but I want to make sure that I get it. You would never accept any money, even if you're up forward and say, we don't really have clarity, we need to keep doing research, but we need a initial amount to do the trips, to go somewhere. You would never take any money, even if that's the case?
No, that's a good question. No, that's not what I'm saying. So I have another Connects video about the stages of capital and when you need them and who they come from. So when you are gestating an idea, of course, you have to spend time thinking about it and developing your minimum viable product and determining your product market fit. And all of those things happen before you have you're developing your go-to-market. You're not going to market yet, right? So you need capital to do that. And a lot of that capital here is available through pitch competitions. There's companies that win several of those and get money. There's the early stage accelerators that have small amounts of money. There's also what's euphemistically called friends and family money, which is usually the first place that early stage companies go to get capital. And that is people that you may be related to or know you and think highly of you as a business person or an entrepreneur. And they're not investing in your idea. They're investing in you because they've known you since you were a child, or they just know that you're someone in the community that has a lot of great ideas and a lot of energy and a lot of intellect and tenacity. And so they think that whatever you do, it's going to succeed. So they give you some money. And that amount of money can be anywhere from, from nothing to, there's certainly companies that are not related to or friends with people that have deep pockets, can write big checks and who are accredited investors. But that can be up to $500,000, that friends and family round. So the initial stages, you do need capital. But when you have a minimum viable product, when you have decided that you want to raise angel investment, which comes before venture capital, angels, super angels, angel funds first. That's what I'm talking about here. These are the things that you have to have. And if you go to angels and say, it happens all the time. I will say people will come to me and say, help me raise money. How much do you need? I need $1 million. Why do you need $1 million? Because people told me I shouldn't ask for more than $1 million. I've heard that more than once. That's not the way it works. You have to know how much do you need? When do you need it? And again, your burn's going to tell you when you need it, because I need enough money to cover my burn until I get to profitability. And if that's 2 years, also, it depends on the market you're in. So if, let's say you're a life sciences startup and you need FDA approval, that could take 7 years. People understand that. And if there's different gates that you get through, phase 1, phase 2, right? There's a lot that you can do. The amount of capital you need to start that kind of a business is quite large, but there's also pools of money to fund the early stages. And we're lucky enough to have several pools of those funds here. Also, if your product is a CPG, consumer packaged goods, the amount of capital you need is enormous and everybody understands that it's going to take years to get to profitability because of all the barriers to entry that there are in consumer packaged goods. So again, the model and the timing and the pro forma depend on the industry you're entering into. But that information, the gross margins that are typical, that's available if you research enough. And I can't sing the praises enough of research librarians. Don't fail to ask them for help. We have them. The Carnegie Library of Pittsburgh is one of the finest in the country. The 4th floor of the Carnegie Library in Oakland has professional research librarians that are full-time and available to you for free. If you need information, go to them. Yes. Anything, just go to them and say, hey, I have this idea and I need to know how many people in the country use this kind of product and what do they pay for it? I'm not going to tell you that they're going to be like a robot that gives you the answer. They're going to say, well, there are these places you can look and come over here and I will show you this database. And this, believe it or not, this book has things, right? There's even books that you might use. There's a lot of information, and they are professionally trained in graduate school to help you find the answers to the information that you need. And they know a lot more than we do about what's available. Okay, so it's not just how much money do you need, not just when do you need it, but what are you going to use it for? So the slide in your pitch deck is sources and uses of cash. I need $750,000. I need it by this time. If I get it, I'm going to do this with it. I'm going to buy property, plant, and equipment to produce my product, which is already working. I'm going to, execute on my go-to-market strategy. I'm going to execute on this part of my business plan. I'm going to hire someone to do this. And when you do the hiring, you first hire it outside of your organization, you do it on a consulting level, then you hire full-time. Hiring full-time should be something that happens after you've proven how much of that service you need. Initially, it's your co-founders that you bring in the expertise through. Okay. All right, so when investors invest in you, now that you've done all these wonderful things, you have a great business plan, a great pitch deck, you've got a great team, you've got a great problem you're solving, you've communicated it really well. By the way, there's a wonderful presentation later this week on pitching to investors and how to create that deck. It's the whole topic. It's wonderful. You have to tell your investors, when will they get their money back? How much will they get back? What will be their return on investment? So again, you do your pro forma and you need capital to get to profitability. Then you're going to have to scale, and you're going to need capital to scale as well. And at some point, you're going to be large enough that you are going to have an exit. You're either going to be acquired by somebody that is larger than you in the market that you're in, or you're going to sell to the management team and found another organization, or you decide, if your goal is not to sell, and I have seen companies here, wonderful companies where the founder says, this is what I want to do. I love this. You have to make sure your investors know your intentions. Some investors are willing to invest in you for the long haul. Some are willing to give you their money for 3 to 5 years, maximum 7, and then they want it back. So you have to know how you're going to do that. How are you going to give them their capital back? The way you figure that out is you look at recent exits in your industry. At what revenue level was a sale made? And at what multiple of either revenue or earnings before interest and taxes and interest, taxes, depreciation, and amortization, EBITDA, what were the multiples of the exit? And that will help you understand the potential return. And then you do the math to say to your investors, this is what you'll get. If you invest in me, you'll get this. And that's really important because as an investor, there's a lot of options out there. Investors get pitched to all the time. When you go to when you're part of an angel investment group, you go to pitches every 2 weeks and you look at 2 to 3 to 4 companies every 2 weeks. So how do you compare them? You compare them on the strength of their business plan, strength of the business model, strength of the team, and what's the return and when. If I'm going to double my money in 2 years with this one, and this one's going to take me 10 years and I'm going to get a return of the same, why would I do that? So you have to be conscious of what message you're giving to investors. If you're thinking of crowdfunding, which we have a lot of wonderful platforms here locally to use crowdfunding as a funding source, you have to think about what are you going to tell the people that are investing in you? What's the proposition for them? And the crowdfunding platforms will guide you through that process. Okay. And now, when you're trying to raise capital, you have to have a pitch deck. And you don't have one deck, you have more than one. So there's a guideline to pitch decks. 10 slides, 2 minutes a slide means you've got 20 minutes to present, which sometimes is generous. Some won't give you that much, but some will give you that and more, but it depends on the setting in which you're pitching. So you need to have, you put your pitch deck together, and you can see lots of people pitch here. We have the McGinnis Ventures competition happening right now. There's lots of people putting pitch decks together. You can come and watch them present. You can go online and look at pitch decks. You can go, Connects has recorded videos on how to structure them. So you have to understand your audience. So if you want to pitch to an investor that you know, that already knows you and thinks highly of you, they might be willing to give you an hour of their time, and you have a lot of time to pitch to them and answer their questions and have a dialogue. If you're just seeking investment and it's just you don't know the investors, you need just enough to get them interested enough to give you more time. So you need to be able to communicate the problem you're solving, the opportunity it presents, the way you're solving the problem, and how your investor is going to make money from you, and how long it will take for them to get their money back in a very pithy, streamlined way. However, I had a McGinnis Ventures, I advised some of the companies in McGinnis Ventures, and I had one that won in 2021. The deck that they presented was about 12 slides, and it was very wonderful. But then they had a supplemental deck that had an additional 70 slides. And the reason you have those slides is you try to envision any question that an investor could have. And then you answer that question, and you have a slide that addresses it in as much detail as you want, but it's not part of your presentation deck. It's in the Q&A after the deck is presented, and they say, great, I like this, but what is your this? You say, very good, I have a slide about that, and you pop up one of the 75. So you're not limited. You can produce as many slides as you want, but the ones you're going to have time to present, you have to tell your whole story, and it is a story you're telling, in those 10 slides, 2 minutes a slide. It's a really good idea to also have sort of this little teaser deck, which is even shorter, which could be attached to an email when you're sending out to potential investors that you may find or be referred to, but that you don't know well. Okay. You need to have an investment summary. Now, this is a one-page document that is very specific. This is a document when somebody says, okay, I saw your pitch. I like it. I think it has potential. I believe in you. I'm an accredited investor. I want to invest. How do I do that? So you have to have a document that says, we are taking in money on a vehicle, convertible note, a safe. How are you bringing in money? What are the terms? Which is a whole nother discipline, but learning about the terms of investment. And what stage are you in? Is this your initial capital? Is this friends and family? Is this your seed round? Is this your Series A, Series B? What have you already raised? How much capital are you raising now? What milestones do you plan to get to with that capital raise? And what are the terms? If I invest in you now, this is my valuation. This is how much, if you invest $100,000, you own this much of my company based on the valuation. There's some wonderful Connects talks on establishing valuation and investment terms that you can watch to get more detail on that. But it's very important to say, the ask, I'm raising this much money because if I raise this much money based on the pro forma, I will get to break even. Plus, I need this much in working capital. So you're demonstrating that you understand how much money you need, what you're going to use it for, and why you're asking them, and then specifically what their terms are. If you invest now, these are your terms. This is how much of my company you'll own. And when I exit, you'll get this return. And I'm going to exit in this much time. All of these things are obviously projections. We don't know. But you have got to make a hypothesis about all of them and document it. Okay, and the term sheet is, again, this is getting a little bit more granular, very specific terms and conditions about the investment. So we talk about if I invest a certain amount, how much do I have to invest to get a board seat? How often will I get communication about your progress? What valuation are you assuming at this point? What are my voting rights? After you raise this capital, when are you going to raise again? How will I be diluted if you raise more capital? Those are all really important questions that you need to have answers to. Okay, so we talked a little bit about this, but just to review, potential investment sources. Bootstrapping is you and your co-founders doing what you can on your own. Initially, that's how everyone begins. And even when you're bootstrapping, there are resources available to help you. So there are things called Small Business Development Centers, SBDCs. There's one at Duquesne that's been there for decades. There's a new one at Chatham that's relatively new. They are funded by the Small Business Administration. So every year in the federal budget, there's a line item for Small Business Administration, and those funds are then parceled out to the states. And in Pennsylvania, we fund small business development centers with experts in all the disciplines we've been talking about. And it's free. It's all free. They're paid by the Small Business Administration. And they're free for you to meet with consultants about any topic you have. And they're a conduit to connect you with other resources and to help you. If they can help you, they'll help you. If they can't, they'll direct you to someone who can. So those are great partners to have while you're bootstrapping. Again, free. Free is good. Friends and family, we've talked a little bit about. Those are people that are investing in you because they know you, have a relationship with you, and believe in you. Seed capital, $50,000 to $1 million. And those numbers could be, you certainly can get seeds. It's a little bit higher than $1 million, but typically, again, it depends on the type of business model that you have. They come from angel invest. Yes, go ahead.
We hear a lot about pre-seed nowadays as well. Would you say pre-seed is anything from 0 to 1 million, or basically 0 to 50,000? Does that include friends and family? I know pre-seeds would be more like accelerators, right? That's the way I usually think about it.
Different people use these terms different ways. But again, anything pre-seed is any money that you get, you're using your own, friends and family, winning accelerators, winning pitch competitions, getting non-dilutive grants. There's a lot of grant money out there too. Those are things that money that you get based on you, right? So if you win a pitch competition, it's because you pitched, or you and your co-founders pitched. It's not an outside accredited investor. Angels and angel funds, those are accredited investors. Individuals are, high net worth individuals that are accredited investors, and they can be on their own and through family offices, which are, investment arms of wealthy families. Yes.
Term sheet for probably start coming in as soon as seed funds level, the term sheet? Do you require that for even like friends and family?
You do, because
then
even if friends and family are going to give you money, they're going to give you money under some terms.
Sure.
They're not just going to say, here's some money, play with it. I'm going to invest in the equity of your business. So you have to tell them when they give you X dollars, it gives them a certain amount of equity, a certain amount of rights, potential return. You have to tell them all of those things. Yes, from the very beginning. When you start taking an outside investment, you need to understand the terms. As long as you're just using your own money, you're good.
Something that can be understood by the founders itself, or it's better to go through an advisor for the term sheet composition?
It's a good idea to certainly start by doing your research, learning about typical term sheets. There's lots of sample term sheets that are available to you. I'm sure there's information on Connects as well, and the Swartz Center has advisors that can talk to you specifically about terms that are typical. But again, they're going to be a little different. They can be different based on geography. They can be different based on industry. So understanding what term sheets look like in your section of the market and the geography in which you're raising money is a good idea. Anybody else? Any other questions? Anybody online? Okay. Okay. This is really important. And this can be the difference between a successful venture and a very difficult situation. And I have seen it happen. It's very important to find investors that are aligned with you, your business, and your business model. Sometimes I've seen entrepreneurs that just need money, and so they take money from whoever has money. And it turns out very badly. So it's important when you think about who's going to invest in your company that you talk with them, you get to know them. You understand why they're investing in you. What is it about your investment proposal, your presentation, you in particular, your team? What is it that is attractive to them, and what are their expectations? How many times have they invested in the past? Are they active or passive? Do they want to have a role? Do they want to have a board seat if they've invested a certain amount? Do they want to have regular communications? Are they happy just to hear from you once a year? It's important to know why they want to invest and what their expectations are of you after investing. It's also important to have investors that are strategic. In other words, they're investing in you because they know the industry you're in. Maybe they were founders themselves that had an exit, or they have had a career in the vertical that your startup will participate in. So somebody that had a career in consumer packaged goods might want to invest in a CPG company business model. Somebody that's had a career in manufacturing understands a manufacturing startup. Someone who has spent a career in the financial world might be attracted to fintech companies because they understand them. Be very aware of who's investing in you and why, and what their level of expertise is in the area in which you're investing. Mm-hmm. Okay, so how do we go about this fundraising endeavor? We make a list, an actual list, an Excel spreadsheet, make a physical list of potential investors. Research them. There's a lot of information available. There's a platform called EquityNet where people just go out there and say, I'm an investor and I want to invest in these kinds of companies. And here's how you contact me. There are angel investment funds that are available. There's investors that you're going to know about, investors that you get introduced to. If you win a pitch competition, that could come with money and connections to investors. If you engage in any kind of accelerators, they're going to have connections. So keep a record of everybody that you've met that is a potential investor and the data that you know about them. How to contact them, what's their email address, so how do you spell their name correctly, what is their job, what part of the country, what kind of investments do they make. And the more you know about each investor, why they invest and how they invest, the better you'll be able to pitch to them. When you hear no, and it's a good thing to hear no, it's a good thing to hear no early and often, so you don't waste your time, which is precious, trying to get an investor to invest in you that doesn't want to. Make notes about why you hear no. If you start hearing no for the same reason from multiple investors, you need to go back to your pitch, your documents, your business model, your business plan, and amend them so that you address those concerns. And when someone says no, do not miss the opportunity to say why. Tell me, why have you decided not to invest? It could be as simple as timing. I just invested in these two companies and I don't have dry powder right now. Or this is an industry I don't know enough about, and so I'm investing over here. Or I'm investing over here because their returns are going to be bigger and the potential return is much larger. Or I'm investing in you, I'm investing because I don't understand the product, the market, who has this product, who has this problem. Why would they use this to solve it? All right, so here's your checklist. Unfortunately, it's not 5 things, it's 17 things, but it is not a simple thing to begin a company. But if you do all of these things, you will have a much stronger, stronger start. And you won't waste your time on doing things that you really don't have to do. This whole deck is available to everybody. It will be available and distributed. Does anybody have questions on anything? Yes.
So you mentioned at the beginning of the presentation, you don't want to ask too much money to pay yourself, or you don't want to pay too much of the investment to pay yourself, right? Obviously, I think, some factors may come in, like, hey, are you working from San Francisco or are you working from Pittsburgh? But how does investors see if, okay, this person took a lot of debt beforehand to get the business started, or they have personal things going on that may impede, at what point it's too much money to pay yourself, let's say, or if those factors could potentially negatively affect you?
That's a great question. So I don't mean you don't pay yourself at all. I just mean I have seen companies that get investment, and the first thing they do is pay everybody in the C-suite and then hire people. And with the expectation that the investors will just keep giving them capital to keep paying people, which is an unreasonable expectation. The pro forma will tell you how much you can afford to pay yourself. So if you can, sensitivity analysis, you can say, if I pay myself $50,000, well, what do I need to live? If I pay myself $50,000, and I pay all of my team the same, what does that do to my pro forma? It's definitely not the case that when you're a startup that you should pay yourself what you might like a market rate. You could be an engineer that in the market could earn $190,000 a year. You certainly aren't going to use the capital to do that because your capital is limited, and that's only one resource. Also, you own the company. So your investment in the company should project your confidence that the company's going to succeed. One way to do that is to invest your time without being paid a market rate for that time, right? You're putting your sweat equity into it. Yes. Yes, thank you. That's exactly what I was just talking about. So you do not, and I have seen investors do this. They have a great idea. I mean, I'm sorry, I've seen founders do this. And again, they get some equity capital, and the first thing they do is start paying them what they might have earned if they were working. You need to invest your own capital if you have some. If you don't have any, then you invest your time without being fully compensated for it. It's, I guess an analogy would be, flipping a house. So you get the real estate, maybe you buy the real estate with a loan, a mortgage loan, and the loan is against the house. And you could then paint the house and repair the house and fix the house yourself. And then when you sell the house, you get repaid for all your sweat equity. Or you could take a bunch of money and hire a bunch of people that are professionals to come do it. And it's going to be a very different outcome when you sell the house. So skin in the game means you have to invest in your business. If you aren't the business's biggest cheerleader, if you aren't willing to work at it without being compensated at a level you would be if you worked for someone else and didn't have an equity stake in the business, it tells investors something very different than what you want to tell them. I believe in this business so much that I'm willing to work on it for nothing or for a very limited amount until we get to solid footing. And then as an owner, I will, increase my compensation as the business grows. And at the end of the day, you're going to get a big payoff because you're going to be the largest owner. Very important. You're still going to have a very large share of the business when you exit. You don't want to dilute yourself so much with each round of funding that you end up losing your company, even though it's quite successful. That's why it's important from the beginning to have a finance strategy that is grounded in reality. If I raise this much money, I can get to profitability. I don't have to spend all my time fundraising for more because I didn't raise enough initially. I didn't have a strategy. I just took a little bit and figured I'd get more later.